Okay, good afternoon. How is everybody? Good. Last week we started off on a new chapter, Chapter 9, on planned assets and depreciation methods. So let's just briefly go over the key points of Chapter 9. And just a quick news flash. Next Monday we're having second midterm. Okay, midterm will be on Chapter 5, 6, Merchandising Operations. Chapter 7 will cover the two main sections you need to know for midterm today. Chapter 8, receivables, accounts receivables, notes receivables. Chapter 9, planned assets and depreciation. Okay, and we have a little bit of Chapter 9 to cover today on intangible assets, so specifically Goodwill. And then we'll cover two main sections of Chapter 7 that you have to know. Bank reconciliation you have to know, and also petty cash transactions. So last week we covered we started off from categorizing planned assets. There's tangible assets that you can physically see by your eyes when you walk into a business, the office, the warehouse, machines, furniture, land, buildings. These are all tangible assets that we can actually physically see. Natural resources, those non-human-made assets. So this is the place that we stopped on last Wednesday. Natural resources, these are the resources from the ground. So this is the second category. The third category was intangible assets. So those related to intellectual properties. You have new inventions, you design a product, or if you have the right to reproduce musicals, CDs, novels, copyrights, patents. So these are intellectual properties that belong to the third category, intangible, and today we're going to cover one of them specifically that's very special from others, Goodwill, relates to purchasing other companies. Now, later on after categorizing the assets, we talked about three different depreciation methods. So what's the first one? Straight line. So what is the feature of straight line? We depreciate the same amount every year. So once we purchase an asset, we allocate it along the years, divided by either the useful life, 10 years, 15 years, and don't forget in the beginning part, we're only using depreciable costs to allocate it along the years. So it should be cost minus residual value, then we divide it by the years. Every single period, we allocate the same amount of expense. Second method was units of production, which also works for natural resources. The units of production, the special feature is that the more we use the asset, the more we use the machine, the more we use the vehicle, the truck, the more depreciation expense we recognize. So every single period could be different based on the usage. The more you use it, the more expense. The less you use it, the less expense. And of course, if you use it on the same pace, then you'll depreciate the same amount. The units of production also works for natural resources. Last week we stopped here. We talked about depletion expense, accumulated depletion. This is a specific term used for natural resources, so the concept is the same. Same as depreciation expense, accumulated depreciation. It's just signaling that this company has natural resources contracts involved in their business. So we'll be extracting either barrels of oils or tons of different kinds of minerals. So when we estimate the expense based on the unit cost, remember per barrel's cost, per ton's cost, and then multiply the usage extracted. So multiplying these extracted units by the cost can figure out every single period's depletion expense. And then we also list accumulated depletion. So the same concept works for units of production is also used in tangible assets, machines, vehicles, specifically natural resources. We apply the same methodology. We went over this example. Again, we started off from the cost of oils and gases, the original purchase price, and we estimate the capacity. For example, 8 billion barrels of oil and gas. If this period of time we only remove part of it, 400 million, then we, first of all, obviously we have to estimate the unit price per barrel, per ton, which is $9. So use the cost divided by the capacity. The unit cost, then you multiply the total parts that you extracted to figure out that period of time's depletion expense, accumulated depletion. So this was the last example we went over last Wednesday. So units of production, again, we start off from depreciable cost divided by total capacity, figure out a unit cost, then just multiply by the units generated, units used. were extracted. So every period of time, debit credit this amount may be different, unless you extract the same amount, 400 million, every single period. Otherwise, they'll be slightly different. Now, after covering depreciation methods, we talked about disposal assets. Right? After using the assets to its full useful years, after 10 years, 20 years, we may decide to either throw away the asset or sell it or trade it for different types of assets. So we break it down into 5 different situations, but the underlying concept is the same. What we're trying to measure up is the money that we're using. We're either paying or we're receiving with the other side. So what we're giving away, what's the asset's book value? Compare it with any amount of cash that we're receiving. But there's differences. If we're receiving more than what we're giving away, then we have a gain. If we're receiving less than what we're giving away, we have a loss. So different situations will give you a different gain and loss value. That was the 5 situations we went over in Chapter 9. Okay? So we talked about 3 methods, 5 different disposal situations, natural resources. The last section here, accounting for intangible assets. Again, these are intellectual properties, specific categories introduced in the book. They talked about patents, copyrights, trademarks, if you have logos, brand names. These are all intellectual properties, basically research, development, designs in the business creation part. So they purchase the rights to reproduce certain products. So all these categories, aside from goodwill, pretty much they're all allocated based on straight line method. So if you patented a product, an invention, you purchased the right to reproduce something, usually you have a lifetime for that, and you just directly divide the cost by the useful life, just like regular straight line method. But the category that I would like you to focus on in this section is goodwill. So goodwill is very different from other intangible assets in a sense that it only happens when a company is acquiring or purchasing another company. So last week I went over a basic example. Let's say you're using $100 to purchase another company. So if you look at that other company's statements, if you look at its liability section, if you measure up an estimated fair market value of their assets, the difference is basically equity part. It's the net worth of the business. So if the net worth of the business is only $20, and I'm willing to use $100 to pay for this company, for purchasing this company. The difference is here, acquiring the company based on the difference of the cash you used and the net assets value. The difference is an intangible asset we call goodwill. So this represents reputation, future potential that your company sees in this company, which is not yet represented in the statement. So this is future potential, reputation, and intangible assets that's not physically seen by our eyes. But there must be something in this business that your company values. That's why you want to acquire this company. Okay, so this is an intangible asset. It's very different from patent, copyright. We don't amortize it based on a straight line method. So in accounting, the rules for goodwill is after you purchase the business, after you recognize that $80 of goodwill, every single year we have to reevaluate this acquired company's value. If the value reduces, then we have to write down goodwill, recognize impairment loss. If it exceeds earlier goodwill, we don't go back to change it. Remember, this links to the accounting conservative concept in accounting. We want to measure out the highest possible losses and expenses. This is considered expense category, impairment loss. Okay, so again, how we measure goodwill. We want to first of all know what is the cash we're paying for this company. And then what is the net worth of the business. The net worth we measure it based on current market value of the asset minus liability. Because right now we're purchasing this company. So we want to know this company, the total assets, the marketable value, what is the value of its assets based on market value, not by historical cost. Minus the liability, because this is the part that after you purchase the other company, their liabilities become your company's liability. So you still need to pay this amount of money back to creditor, back to either wholesaler or supplier who you owe money to. So these two, the differences, if you match it with accounting equation, assets equals liability plus equity. So assets minus liability basically is equity, net worth of the business, but it's based on market value. So the net worth of the business, if you compare it against the cash you're using, the differences is what we consider the good reputation, the potential in the business that you're purchasing, which is not stated in the statement yet. Okay, so this section here, you have to know how to calculate goodwill. If you have a problem, you have to, first of all, pick the information. What is the cash you're using? The information, what is the liability of the business, of the acquired business? What is the fair market value? These information will all be given to you. What you need to know really is there differences between the cash you're paying and the net worth of the business? If there is this considered intangible assets to your company, not to the acquired company, because now you're purchasing the assets. We're doing the accounting for your company. Okay, and again, the differences between this and all the other intangible assets is that we don't amortize goodwill based on a straight line method. We reevaluate it on a yearly basis and reevaluate the net worth of the business that we purchased. If it decreases, we recognize impairment loss. If it increases, we don't go back to change it. Okay, let's take a look at an example how we apply this. Let's say a company wants to purchase another company called Seacoast. They're willing to pay $170,000. So that underlying part is the cash we're paying for this purchase transaction. Okay, and another thing is that goodwill only exists for company-to-company purchases, not for other types of assets. So it only exists when a company is acquiring another company. So when you see this category on any company's financial statements, you know within this year or earlier before they purchased another company, but not other types of assets. And if we continue to read this, the acquisition, the other company, Seacoast, they have a reported assets value of $130,000. That's the historical cost of the assets. And the fair market value, the estimated current replacement cost of the asset is $100,000. So that $100,000 is our base of calculation. Because remember, we're using the fair market value of acquired assets. And we need to subtract liability, because within those assets, creditors need to claim part of it later on. So that's the part that does not belong to our company, because it has to be paid to a creditor, to other parties. So the liability part value is $70,000. So what is the net worth of the business? $30,000, right? Fair market value of assets is $100,000. Liability given to you $70,000. So really the net worth of the business, the equity part really is only $30,000. So we know the value of the company that we're purchasing. On the other side, we also know what is the cash we're willing to pay for this purchase entry. So what is the level of goodwill? You have cash, you have $30,000 on the other hand. The difference is goodwill. We're comparing the cash we're using with the book value, of the net assets value based on fair market value of assets. So the difference here is we're willing to use $170,000 to purchase this other company. Its net worth is only $30,000. This excessive amount of cash we're using is an intangible asset that relates to that company's future potential that we see in this purchase entry. It's not now, but it's future potential reputation of that acquired end company. Okay, so again, we're comparing the cash with the net worth of the business based on fair market value, subtract liability. The equity part valued by current market replacement cost. So the cash minus the net worth of the business, excessive amount of cash you're using to purchase another company will represent this as an asset that we're not seeing by our eyes. It doesn't have a physical form yet. So there must be something you see in this acquired company that your company is lacking, and you would like this to compensate your company's lack part. So this is the calculation of goodwill. What about journalizing then? If we say goodwill is an asset, that means what's the normal direction? Debit increase or credit increase? It's an asset, debit increase. And from the statement here, the problem statement here, you know that we're paying cash. So you know we have cash asset reduced since we're purchasing a company. We have an intangible asset increased since this company's net worth is only $30,000. We're willing to use $170,000 to purchase it. So you know one side of the debit account is goodwill, the other side credit account is cash. These two other accounts basically is that company's assets value and that company's liability value, which later on when you purchase it in becomes your asset and liability. Okay, so this entry here always involves 4 categories. You definitely increase the assets of that acquiring company. You definitely increase your liability based on the company's liability. It later on becomes your liability. You're using up cash, and if this cash is excessive amount of cash compared to the net worth of the business, then you have intangible assets goodwill. Okay, so once again, this intangible asset goodwill only works for companies purchasing another company, only for this case. It doesn't work for other types of purchases. Because other types of purchases, generally we will recognize this as a loss. If you're using excessive money to purchase a thing that doesn't worth that much, you recognize that, generally speaking, for other types of assets, it's a loss. If you think about disposal asset situation, you're receiving less than what you're giving away, you have a loss. But for acquiring company, this company must have foreseen something in the other business that will compensate them, that has a cutting advantage. That's why they want to purchase the other company. So for these, we're using the market value of assets, subtract liability, the net worth of the business, $30,000, compare it against the cash we're using. If this cash amount exceeds that $30,000, we have goodwill, which is the remaining part, $140,000. Okay, any questions? So this is pretty much all the key concepts you have to know for Chapter 9. Again, what are the categories of planned assets? What is the depreciation methods? 3 types. You have to know how to calculate them. After calculating depreciation, you have to ask yourself, what is the current value of the asset? Because the whole point of depreciating asset is to figure out what is the current book value. After depreciation, after usage of assets, how do you take care of the assets after its useful life? Are you going to throw it away? If you're throwing away, you definitely have a loss. Anyhow, since it has a residual value at the end. If you're trading for other assets, compare book value with what you're receiving. Is there a difference? If there is, you most likely have a gain or a loss. Are you trading for a similar type of assets or different types of assets? You have to ask yourself these questions when you see a problem statement. How you journalize them may be different for different situations. Natural resources we just covered. Always use units of production to estimate depletion expense. For intangible assets, you have to focus on goodwill. Okay, for all the patents, copyrights, I won't be testing you on it. Okay, so you only focus your studies on goodwill. How to calculate it, how to journalize this purchasing company entry. Yes. Format of second midterm, generally speaking, the same as first. We still have majority of the questions by multiple choice and some of the questions problem statements. So Wednesday I'll go over and review a little bit what's the key concept for exams, right? Okay, let's go over a few questions, multiple choice questions, to help you understand the concept, make sure we're on the same page. Now, after all the topics, what is depreciation? Is it D? Right, what is depreciation? We're allocating the cost of historical purchased assets. We're not using cash because this is an estimation in accounting. Assets are really, we're not paying the assets to anybody. We're not selling it to anybody. We're really just recognizing how we're using the asset, right? So this is the process of allocating planned assets cost along its life. Along its life could be based on actually years, could be based on how we use it, units generated. Double declining, you have an accelerated method in the first few years, recognize more expense than later years. Right, so we're not using cash to replace planned assets. Now, this is the concept of repairment, right, not depreciation. So repairing could be using cash to fix an asset. Then the question would be, is this fix, this repairment, is it major or not? If it's major, adds life to the asset, you have to capitalize. Minor, it's considered expense. First, a choices is the process of valuation that records the decline in market value of plant assets. Now, after we purchase in an asset, it's recorded as historical cost. We go back to change it based on market value. So it's not A. Okay, so it's C, a process of allocating assets cost over its life. Okay, next question. What depreciation method produces constant expense? Should be simple, straight line, right? We allocate it based on the number of years, so every single period we estimate the same amount of expense. Units of production, it varies based on the usage. Double declining, remember the formula is book value multiplied 2 over life. So the early years we have a higher book value, early years we have higher depreciation, and then it gradually decreases. Now, the charge of allocating the cost of natural resources used up during a period is called, what is the term we use? Depletion, right? Depreciation is used for tangible assets. What about amortization? Intangibles. Right? We haven't covered this in detail, but amortization is a term we use for intangible assets, for patent, copyrights. For Goodwill, it's a special intangible asset. Usually it's listed aside from other types of intangible assets. It has a special category. So Goodwill is a special, one of the intangible assets that we'd like your studies to focus on. For others, we usually amortize it along the useful years as well. Now, extraction, we don't have this term in accounting, so this answer here is depletion. Which of the following would be included in the cost of land? Now, assuming that we have all the 3 costs here, assuming that we purchase a piece of land, the purchase entries, at the same day we also have to pay the broker's commission, we have property taxes, we have the cost of clearing and wanted buildings. Are we supposed to journalize all of them or just one of them? All of them. So if you go back to read the land section, remember all 4 categories, I would like you to focus more on land than other categories. You have to know the difference between land and land improvement, because land we usually don't depreciate this category. So land is the only tangible asset that we don't depreciate. After we purchase the piece of land, all the necessary costs, these 3 occurs. All of them, you have to journalize them all together. So it's not just the value of that piece of land, but also property taxes, the cost of clearing buildings on top of the piece of land. A land improvement is another category, the things that you do see on top of the land. Right? Fences, sparkling systems, signs, relatively minor costs. So those are depreciated compared to land. Again, land is not depreciated. So you have to know how to differentiate these 2 categories. Now, the same concept also works for machines, for buildings. And machines, when you purchase it in, not just the cost of the machine, assemble cost, transportation cost, just like how we calculated the cost of inventory. All of these have to be added together under one account. Okay, that's the end of Chapter 9. Any questions on Chapter 9 before we move on to a new chapter? Nope. Okay, if you have questions later, catch me after class. Chapter 7, Internal Control and Cash. This is a whole other area. So we talked about receivables, current assets, and some part of it is long-term assets. We talked about plan assets. This chapter is very different from others. We talked about a lot of controls, sets of procedures in place in the business to help basically safeguard the assets. The later of the chapter specifically focuses on cash topics. So this chapter here, I will not be covering all of them, and you're only responsible for the part that I cover in class, which mostly focuses on bank reconciliation and petty cash transactions. Okay, all the other categories all the other sections in this chapter are management classes, auditing classes will also take over most part of it. So I like to focus on mainly the ones that are more on the accounting side. How do we reconcile bank statements cash balance with your company's cash balance to figure out a correct cash amount to report it in the balance sheet? How do we take care of petty cash when we assign a set of funds for minor expenditures? When employees and staff uses that funds and money, how do we report it on the transactions? How do we move it to T accounts and report it in balance sheet? Okay, so these categories, this chapter in the beginning part, you just have to know the basic idea of what internal control is, and then we're going to skip the middle part. We're going to talk about more on bank reconciliation part. So the idea of internal control really is sets of procedures, processes in place in the business to help, most importantly, protect what the business has, safeguard the assets. So if we step aside from the business world for a minute, you just think about where you live, home, your property. What are the basic things that you will do, the things that you will set inside the home and where you live as a control device? Fences, land property. You have fences around. What else? Locks. Definitely you have a door. You have a lock. Inside you probably also have set alarm systems, fire alarm systems. Is there excessive amount of smoke? So these are the basic things that you will set in place inside your property to just help you and your family to be more protected. So you have a door to block other people, other things. You have fences around to signal what's the area that belongs to you. You have some alarm systems, red flag systems. The same logic works for a company. Right? A company, the most important thing is assets. If it's plant assets, it helps the operations. Right? If it's inventory, those are the most important assets for merchandising operations to sell to customer, generate profit. So these are the sets of procedures that company has in place. For example, each and every employee has their own responsible duties. They have authority over some information, but maybe not all of them. Perhaps also they have access codes, passwords to only some set of information that relates to their department, but not other departments' information. If you look at the accounting department, who's taking care of handling the cash, giving out cash, receiving cash, should not be the same person as the one recording these information. Otherwise, you may collect $100, record 50, and put another 50 in your pocket. So segregating duty is a basic internal control in the business, right? For confidential information, research development department, when they have the information on the cutting advantage in the business, the product they're putting together, the product they're designing, those informations may not need to be leaked to other departments of staff. They don't have the right to look at those confidential information. Okay, so these are just the basic idea of internal control. Basically, generally speaking, is the sets, procedures, processes to protect companies' assets. And these policies have to be communicated to employees, making sure that the operation cycle is working efficiently based on the policies, based on the procedures. So another example of operation efficiency, for the purchasing acquisition department, you will definitely want to communicate, if you're the manager, want to communicate to the staff to purchase materials, same quality, but at the lowest possible cost. Why? Later on, lower cost, lower expenses will boost a higher net income. Higher net income turns into retained earnings. Retained earnings shown on the balance sheet. Right, so these possible costs can also help company to reduce some of the expenses to boost a higher income. And at the end of the operating cycle, what we're learning in this class, most importantly, is this part. We want to ensure accurate, reliable accounting records. So based on the transactions, the events that happened, we have source documents to base it upon. We use the source document to journalize transactions. If it affects cash account, we debit cash. If it reduces accounts receivable, we reduce accounts receivable based on what happens. So this part really is the core of our entire class. Reporting, accounting, transactions based on accounting principles, capturing business events. Okay, so how do we link this to bank accounts? So just like company, just like personal accounts, you and me, we may have opened up bank accounts, maybe one, maybe multiple ones. If you have allowances from the parents, if you have part-time job, you have salary coming in, most likely you will have a bank account to control over the cash. And at the same time, you can also earn interest, right, on a monthly basis. So for companies, same logic applies. Companies, they have operating income, all the cash they receive, so oftentimes they also open up a bank account to control for these cash. Now, if you open up a bank account, and later on all the activities that relates to cash, we have different types of source documents to take care of it. So, open up the account, we have signature card to back it up, meaning that we open up the account, who is the authorized person that made this event happen. And then, what is the amount of money we deposited in this account? You have deposit tickets to fill out. Later on, if you're writing on behalf of the company a check to a third party, either to creditor, to supplier, writing checks, the check itself captures the date, the balance that you're paying off to a third party. What is the reason of this transaction? And you also sign it off. So these are some of the documents that relates to using up the cash on behalf of your business, using the cash that relates to your business's bank account. Every single month you will get bank statement from banks. So nowadays, online system is very popular. Usually you can view the bank statements online, not just the company's account, but also your own bank account. Electronic funds transfers, these are special categories that's only popular in the recent 2 decades. So nowadays, if you have salary received, typically you can ask for a direct deposit that can directly be added to your account rather than receiving a check. You may also be purchasing things. Company may also be purchasing items based on debit card, credit cards. All these electronic fund transfers will directly add on or subtract from your bank account or to your bank account. So these are the things that, based on nowadays technology, we may have a timing difference in recording cash. So this typically happens at the end few days of the accounting cycle. So meaning at the end of the day, at the end of this period, when I'm doing the statements, making financial statements, income statement, balance sheet, I need to match my company's book with bank statement for some of the missing information. This is the purpose of bank reconciliation. Okay, so later on we'll be doing an exercise on actually creating a bank reconciliation. What we're doing again is match bank statement with our company's accounting book to adjust the differences. And these differences typically is due to time lag. So we may have deposited money in the bank, we already added to our company's book, but it hasn't shown in the bank accounts, the bank statements yet. Typically take a day or two to show up on the bank statements. You may have checks that are written up, so paid to the third party. So the third party hasn't went to cash the check, hasn't cleared the bank. So the amount of money we already reduced from our book accounts, and it hasn't appeared in the bank statement, hasn't been deducted from the bank. So these time differences typically happens at the ending few days activities, and when we're generating financial statements, we need to make sure what is the correct cash balance based on matching these two. Matching bank statements, cash balance, with our company's cash balance. Now some of the things, since we have direct deposit, debit card, credit card purchases, some of the items may be added or subtracted to and from the bank's account based on your company's bank account, but your book has not updated yet. So both sides may have incomplete information. We need to match it against each other to figure out a correct cash balance before we generate financial statements. So again, the purpose of bank reconciliation is to figure out the correct cash balance, since due to timing differences, either side may be lacking some of the information. But of course, if your business doesn't have majority of transactions that happened in the last few days, probably these two have the same amount. But most likely, daily transactions could happen. So we may have daily deposits, daily payments, and some of the payments may happen at the end of the period, at the end of the month. So based on these timing differences, we need to reconcile these two numbers. So let's take a look at what a bank reconciliation needs to adjust. So the first part, we have information from our cash account, from our company's accounting information systems. You can call the general ledger, take a look at the cash T account balance. So that basically is the book side. What is the cash balance showed up in our book, the first category. Second, we receive either from online or mailing system bank statement. So the bank statement has the bank current balance of cash. These two, we reconcile them, making sure what is the transactions that both sides appears, what are the things that either side appears, the other side is missing. So these typically relates to outstanding checks, meaning our company already wrote the check to a third party. The third party hasn't cleared the bank yet, so this is not deducted from our bank account. Deposit in transit. I added this money, $1,000 that I own, deposited it in the bank, hasn't showed up in the statement yet. These are the deposits on the way. We also have to adjust it to the bank balance. EFT transaction, electronic fund transfers. So direct deposits, credit cards, debit cards, there may be a time lag differences that you see these items in the bank statement where your company hasn't updated your book. So these are not only, we don't really just have three categories, there's also other categories. So specifically, if we take a look at the bank side first, this is part of the bank reconciliation, the upper part. So we start off from the beginning balance, which is the balance you see from bank statement. So assuming that we have $14,070 of cash based on our bank statements report, then we need to add in, subtract the part that you see in your book, but it's missing in the bank statement. So the ending few days of the period of time, you may have deposited $9,000, you add it to your book, deposited in the bank, not yet represented in the statement, added to this bank reconciliation. So this is an internal document that only for the business inside of the accounting department to view, to reconcile, to make sure the correct amount of cash. It's not for revealing to outsiders. Subtracting part, outstanding checks. You may write a check to customers, to different parties that worth $2,000 that hasn't been deducted from your bank account yet. So based on your bank balance of cash, add the part that you see in your company's book, not yet in the bank. Subtract the part that you subtracted in your book, not yet in the bank. Not yet been deducted in the bank. So at the end, the adjusted bank balance, really this $21,070 is the accurate level of cash that belongs to your company's book in this period of time, not $14,070. So this is the bank side part. If you look at the book side, just to double check whether this amount is correct, in the book side, we start off from the books of cash balance. Assuming that it's $21,000, we have the balance from the book. And then we need to add the part that showed up in the bank statement that's not yet in your book. You haven't recorded them, haven't updated them. So these typically relates to the electronic fund transfers part that automatically added to your bank account or has been paid out to a third party. If you have utility bills set up as automatic payments, you may have subtracted this bill but you haven't updated your book. Right, so these two parts, you add the part that bank statement shows that are missing from your book, subtract the part that, again, bank statement's already deducted, that your book has not updated yet. Other categories may have received a check from customer, deposited a check, but later on proved that the customer does not have enough money. So for the NSF, non-sufficient fund checks, we have to, for now, reduce it from our book. Right, those are the money that hasn't come into your business. You thought it already received it, but you haven't received it later on since the customer does not have enough funds. So later on, the company needs to continue to pursue. These are considered accounts receivables not yet received. So it goes back to Chapter 8, where we reduce how we continue to pursue the receivables. And for now, we need to reduce it from our book as earlier we already added in. And some of the service charges, cost of cleaning checks, these are some of the deduction amounts that appeared in bank statement that your company perhaps haven't learned about it until the end of the month. We just need to reduce it to match it against our company's book. Okay, so basically the key point is we match the bank statement with our company's book. You can just cross out the part that both sides appears. For those that appears only on one side, adjust it to the other statement. It appears in the company's book, not yet in the bank statement. Add it or subtract it in the bank reconciliation. If it's in your book, some of the items in the bank statements that you don't see in your book, add it, subtract it in your book on the bank reconciliation, the second part. Okay, so this is what it looks like for both categories. Again, we start off from the bank side, use the bank balance, match it against with the book, what's appeared in the book, not yet in the bank, add it, subtract it here. Right-hand side, start with a book balance, the same example that I showed earlier, add in the parts that bank already added, your book is still missing, not yet updated. Subtract apart, again, some of the service charges, some of the EFT fund payments that you haven't reduced from your book, just match it against bank statements amount. So the key categories for both sides. Mainly, generally speaking, bank statement part may be missing the deposits that you just did in the last few days, missing the outstanding checks that you wrote off that hasn't cleared the bank. On the book side, it's missing the electronic fund transfers, either receipts or payments, and also interest revenue that earned from the bank account that you haven't updated your book. Non-sufficient fund check, later on you realize there's bounce back checks, so you have to reduce this amount. And also some of the service fee charges, non-regular receipts, basically those payments, and you have to subtract it from your book. So typically you only learn about this when you actually match it against your bank statement, which usually happens either at the end of the year or a certain time point when the company sets to reconcile both statements. Some of the errors part is earlier when you match it. If you match it with your bank statement, realize there are differences in the dollar amounts of the check. Go back to check the source document, make sure whether it's the bank's error or your company's error. So obviously, if it's the bank's error, you have to contact their representative. If it's your book's error at the end, you also need to adjust this part at the end before giving out the statements. So the goal for this reconciling part really is to figure out a correct cash balance. This is the key point here. Okay, I know this is a lot of different categories, so let's take a look at specifically after recording the bank side, the book side. Another thing before we do the exercise you have to know is these adjustments that we make on the book side, we also have to journalize these transactions. So meaning that these are some of the things that we haven't captured in our accounting book after we match it with the bank statements. The collections of money typically linked to accounts receivables. Earlier we made either a selling transactions to customer or other types of notes, receivables that later on we collect from customer. Interest revenue, we also need to increase our book, increase cash, increase interest revenue. So these four items, when we journalize them, the good thing is all of these relates to cash. You just have to know what is the other side of the account. So the first one, if you adjust $100, you have to go back to check what this $100 relates to. If it's an accounts receivable, then you reduce accounts receivable, collect the cash $100. Second category, we talked about interest revenue. When you match it against bank statement, you realize there's interest that came in, you haven't updated your book. This is a journal entry, increasing cash, increasing revenue. Other payments reduces cash, so the other side typically is expenses. Okay, so if it's like service charges, minor expenses, usually we just put it under miscellaneous expense or specifically service charge expense. Others, if it has a specific title, utility, or other supplies expenses, you recognize it under its specific account. So we only need to, after doing the bank reconciliation, we only need to journalize the book side of adjustments. Why don't we need to adjust the bank side? Because the bank side is the bank's business, right? Our company, these journal entries relates to the book side of the adjustments, which is after matching with bank statements, these are the things that we're still missing in our book that we have to journalize. All the other entries has already been journalized. These are the minor charges from the bank account that we learned from bank statements. We have to adjust these in our accounting book. But for the bank side, that's the bank side's accounting department's issue, not our company's issue. Okay, so after creating bank reconciliation, you only need to journalize the part that relates to your book's adjustment. Take a look at an exercise problem. Okay. Let's try to do one bank reconciliation now to make sure you all understand this. Okay, so what's shown on this slide is, upper part is the checkbook, meaning it's the company's accounting book. So they journalize different transactions. You have the deposit side, you have the cash payment side, the check side. And here's the ending balance in our book, cash balance, $13,025. Here's the bank statement. That should have matched with the book, but some of the things are missing there. The first step for you to do is you can first of all cross out the items that you see on both sides. Those are the things that you don't have to address. Cross out the transactions that you see in your book and also in the bank statement. After you cross out the same transactions, the transactions that appears on both ends, you start off from the bank's balance, $370. So for the things that only appears in the book, but it's not yet here in the bank statement, added or subtracted. If it's a cash receipt, added to this $370. If it's a cash payment, subtracted. For the upper part of your bank reconciliation, the first section, you start off from $370 bank balance. Then you add, subtract the parts, the things, transactions you see, typically the last few transactions that appears in the book that may not be in the bank statement yet. The second section, the other way around. Start from 1,325, add and subtract the ones you see in the bank but not yet in the book. Okay, if we take a look at these cash receipts, cash payments, transactions, so first of all, the first part of bank reconciliation, again, we start off from 370, bank balance. We want to adjust, add in the parts that you see in the book, but it's not yet here. So if you look at each and every transaction that happened from the beginning of November, so the first one in the book, you see Java Joe's $15 of cash payment. So is this here? It is, $15, $622. Right. The second one, dividends received, $130. You have deposits here, $130. So it also appears here. Right. 623 Skips Market, $55. Is it here? It is, 55. Now 624, there's an error here. You see an asterisk here telling you this is the correct amount of check number 624, meaning that there's a book error that we made earlier. So the book error, we recognize that 624 as $75 only, which in reality the check really was $115. So this is the part later on when we adjust the book side, we have to reduce $40, the differences between these two. Meaning that payment should have been $115, which we already did, but we recorded as $75. So that's later, when we adjust the book side, we have to reduce $40. But in the bank side, we don't have an error here. This amount is correct. Okay? Because this is payment, so we have to reduce another 40, right? Since the correct amount we already paid $115, but we recorded as $75. So we have to reduce another $40. So this is because it's a payment we made. If it's deposit side, then we add it. Okay? Now for the next category is cash we paid out $60 directly. This $625, we also have 60, right? 626, $85. Is that here? $85 is not here. This is the part that's either outstanding checks that we wrote, but it hasn't cleared the bank yet. So this is the part that's still missing in bank statement. 627, upstate realty, paycheck, 265 payments, and 1,210. All three transactions are not here. So these three are the parts that bank hasn't showed up in the statements yet. We have to subtract the part that we paid, add in the deposit that we added in the book. So we're using 370 as a base, subtract 85, subtract 265, add 1,210. Meaning these are the transactions we already updated our book. It's just on the way. It hasn't showed up on the bank statement yet. So if you look at the dates at the end of the year, at the end of the month, 26, 28, 30, based on timeline differences, we have to update bank statements balance in our internal document, bank reconciliation. Okay, so this is the bank side. I'll show the complete reconciliation a little bit later. If we look at the book side, we start off again from the balance, 1,325. And now we're looking at bank statement transactions. What are the ones that are missing in our book? So again, the 130, 15, 55, we already matched these three transactions. Now remember we had a book error here, 624, but here in the book we recorded as 75, so we have to reduce, subtract $40 based on this transaction. This, both sides also have. What about these two? $35 printed checks, service charges have been reduced in our bank account, but we haven't recorded in the book yet. So these are the $2 amounts that we have to reduce based on our book balance. Lower down $35, lower down $20, and also the differences between 75 and 115, the $40. Okay, so you're just looking at one balance and match it against the other. You're using bank balance as a base, the beginning section, and you match the things that you see, the transactions that you already recorded in the book, but the bank hasn't showed up yet. The second section, you're using the books balance, and look at the bank statements transactions. What are the things that you see here that you don't see in your book? And you just adjust that book balance. So both sides have some of the information that the other side doesn't have. That's why the whole point of this reconciliation is to figure out the correct cash amount. So if we update the parts that we just talked about, again, the bank side, we start off from 370, add the deposit in transit, the last 1,210 transaction. Subtract these two checks that we already wrote, has it cleared the bank, figure out the correct balance of cash for this period. So for the book side, we start out from the book's balance, subtract. In some cases, we may also need to add the electronic fund transfers if it's a receipt. But this problem here, we don't have any receipts. So if we match it with the bank, we just have a book error that we need to correct, and also the cost of checks, service charges, that has already been deducted in our bank, but our book hasn't updated yet. So these two numbers at the end should match with each other. They should agree with each other. Otherwise, it represents something that you're still missing. Either an error that you haven't figured out, or some of the items on either document that you haven't updated, on the book side or the bank side. Remember, these two at the end has to equal the same amount of money. So this is the cash we're reporting in our balance sheet this period, 1,230. Any questions on this section? So the key point here, key takeaway is we're matching two documents to figure out the correct cash balance for balance sheets. Either document may not have the full amount of information because due to time differences, we may have deposits, we may have bank receipts, bank payments that we haven't updated the company's book, or the bank is still missing some information. So, of course, again, if you don't have that many transactions that happened in the last few days of the period, the numbers, these balances may be exactly the same. You'll perhaps already have the correct cash balance. But typically, that's not the case. So every single day in the business, large businesses, they have many transactions going on. So the last few days, we really need to reconcile to figure out the correct amount of cash based on matching the two documents. Okay, if there's no question, the last section of this chapter I'd like you to know is petty cash transactions. So this section here, really, we're just setting aside a certain amount of cash. Not very huge, just perhaps a couple $100, or at most $1,000. Set aside a fund especially to take care of minor expenditures. So meaning that for most of the large business events that happens in the business, we journalize each and every event as it happens. In some cases, typically for transactions that are, generally speaking, lower than $50 or $60, we usually use petty cash fund to expense for these minor expenditures. So we don't really journalize these minor expenditures every single day on a daily basis. We wait until we replenish this petty cash fund to record all these expenditures all together. Okay, so the idea of petty cash is to set aside a portion of cash that's still within the business. It's just specifically used for minor expenditures. So when staff or employees come to you for taxi fares or transportation, bus fares, these minor expenditures, we will use petty cash tickets. Ask them to sign off on petty cash tickets, and we directly reimburse the cash to them. And we don't directly journalize these minor expenditures until we replenish petty cash to bring up the balance up to 200 or 500. Different companies may have a different designated balance for minor expenditures. But we only wait until replenishing the cash fund to journalize all these small transactions together at once. Okay, so the idea of petty cash is just not to write a check or journalize every single transaction, those minor ones, on a daily basis. So wait until perhaps a month when we update, replenish petty cash to journalize them all together. So again, you have to have a control system, you have to have somebody taking care of petty cash funds, and all the expenditures have to be based upon a petty cash ticket as a proof, just for where the cash is being used, who has requested for the money, who's the party, who's the person that has designated and gave out the money to that staff, to that employee. So first of all, the first step is when we set aside this fund at $200, $500, this is the first journal entry of creating this petty cash fund. So really it's just moving your cash $200 to another cash account. Both accounts are within the company. We're just moving an asset to another asset account specifically for minor expenditures. So we would debit petty cash, credit cash, and bank. Now this is just our regular cash accounts. Petty cash account at the end really, when it comes to balance sheet, representing these two accounts, most of the business they merge it together, just represent it all under cash. So for the purpose of setting aside, having a record of, we have actually set aside minor expenditures funding. Usually they will journalize these transactions just to represent there's $200 fund for minor expenditures. So this is a journal entry of creating this petty cash fund. After creating this system, meaning that we have $200 cash on hand, so anytime when staff comes to you, employees comes to you to reimburse these minor expenditures, you can directly hand in cash to them rather than writing a check, rather than waiting a few days to give them the money. You can directly reimburse this money by asking them to sign off on this petty cash ticket where this money has been used, and you authorize this money, if you're the person in charge in the accounting department for this petty cash fund, just directly reimburse them the money in exchange for a piece of document proving where this money has gone to, petty cash ticket. Okay, so the petty cash ticket has, again, the events that happened, what you purchased, where the money gone to, what is the date, the person that requested it, and the person in charge of this money. Now, after a period of time, company can decide the period of time. It could be 2 months, 1 month, or just when the custodian thinks that the money has to be reimbursed. So when it comes to reimbursement, the idea is that you add up all the petty cash tickets plus the remaining cash you have on hand. These two add together have to match with $200. So the underlying idea of petty cash fund is that this is what we call Imprest System. Basically, it's just the logic underlying petty cash funds. So all the tickets, the expenditures, proof, plus the money you still have on hand, add them together, has to match with the designated balance of petty cash. So when it comes to reimbursement, we need to, first step is, what is the total expenses we made? Petty cash tickets. Add them up, and then make sure that what you have on hand, the cash you have on hand, add them together to see whether it equals petty cash fund balance. If it does, all the cash you have on hand subtracted from the petty cash fund, the parts that you use, petty cash tickets, is the part that you will get replenished based on the company's cash account. Now, some cases you may be missing $1 or $2, or perhaps more than that. So perhaps earlier, if you gave out hand in to the staff, you're missing $1 or $2, or actually you gave them $1 or $2 more. So in some cases, if you have cash shortage or cash over, when we replenish this petty cash account, we need to account for this missing dollar amount. Okay, so this case here, assume that we set aside $200 of petty cash fund for minor expenditures. At the end of this month, we figured the total petty cash tickets we have worth $80. So supposedly, we should have had 120 left this month, right? So if we actually count the cash we have on hand, it's only worth 118. So meaning that earlier, somehow we lost $1 or $2. Of course, this shouldn't be a regular case. If it does, the manager should really rotate the person who's taking care of this petty cash ticket or have other internal controls policies over it. But if some cases this doesn't happen regularly, sometimes when it happens, we have to record these missing dollars under another account called cash short and over. So you can think of this account, we categorize it under expense accounts because most cases we'll be missing money instead of having more money than we're supposed to. So these expense part, when there's shortages, we have to debit this account. And what we're doing here is recognizing the expense that we made, and this is the replenish part, $82. So again, the designated balance, assuming it's $200, we use up $80. Some of the employees and staff came to you to reimburse these $80 already. You gave $80 to them. So now you have $80 worth of petty cash tickets. You're supposed to have 120 on hand, but if you count the cash you have on hand, there's only 118. You're missing $2. So these $2 we debited just like regular expense accounts, just to recognize the differences here if it's untraceable. Right? So when we comes to replenishing petty cash, we're supposed to replenish $80, then now we're missing $2, so we're replenishing $82. So this $82 we credit cash. The debit side, we have office supplies used, delivery expense, cash short and over. So this entry captures the minor expenditures that we made earlier all together. If it's more than 2 transactions, when we have supplies, delivery expense, transportation costs, those expenses, we debit all the expenses, we journalize them all together at the end of the month, those minor transactions. Okay, another case, if we have $80 and our designated balance was 196. So we're supposed to have 196 minus $80, which is how much? We're supposed to only have 116 on hand, and we now have 118, so we have actually cash over the supposed amount. So we have excessive amount of cash, then this category, we still use this category since it's called short and over, but we will credit this amount, $2. So this is the part that when we have shortages. So again, the whole purpose of this entry, this whole section, petty cash section, you have to know how to create a petty cash fund, debit petty cash, credit cash. Second, when it comes to the end of the month, the end of the quarter, we replenish the minor expenditures that we use by debiting them all together and credit cash. Okay, let's apply this to an example. So let's say that we have these expenditures, petty cash tickets numbered 1, 2, 3, 4, 5. Some of them are delivery expense, postage expense, supplies expense. Now, first of all, before these expenses, let's say we created a petty cash fund that worth $370. So how do we journalize this petty cash creation? How do we journalize at the end when we want to replenish all these expenses, capturing these expenses? How do we journalize it? 2 entries. I'll go over that in 2 minutes and try to see if you can journalize them now. Okay, this problem here, what is the total amount of expenses we made? 210. So if we add up 25, 15, 35, 55, 80, 210 is the total expenses we already paid off to staff, to employees earlier, based on petty cash plan 370 we created. So the differences between these two should be the money we have on hand, which is 160. But this problem tells us that we only have 147 on hand. So we have shortages, $13, right? So this $13, when it comes to replenishing the money, the transaction, we have to replenish it up to the designated balance 370. So we're replenishing not just 210 expenses, but also another $13. Okay, so the first transaction here, creating the petty cash, we just move around our cash in our cash account to another accounting department, specifically petty cash account. So you can think of that as a subcategory of cash account, because when it comes to the end balance sheet, it's reported together. Okay, so we're using up our cash, created petty cash account 370. Part of these we use to pay off delivery expense, other minor supplies expenses. So if we replenish this account later on after a month, we have all these expenses, we debit them all together. So remember, the whole purpose of petty cash is we don't record these minor expenditures on a daily basis. We aggregate them and only record them at the end of the period when we're replenishing the cash. So we debit all the expenses, compare it against the cash we're supposed to have on hand, which is 160. Then these two do not match. We have shortages, or we have a little bit over. We debit the shortage, credit the over part. Then we credit cash because now we're replenishing petty cash balance. So these 223, we'll be writing a check directed to petty cash fund. So petty cash fund will be replenished again up to its designated balance, $370. Okay, so this section you just have to know the two entries here, how to create petty cash, how to add up these expenses, match it against petty cash balance, see if there's shortage or over, how to journalize this entry.